Welcome to Conversations at SC, being held on the sidelines of the World Capital Market Symposium. Good afternoon and thank you, Theresa, Burton and John Goodall, for being with us this afternoon. Theresa Burton is the DCE and Chief Operating Officer of Trillion Fund, as well as co-founder of Busbank UK, while John Goodall is the co-founder and CEO of Landbay UK. Now, to get this conversation going, I would just like to start by asking each of you to just tell us your life journey, as it were, as to how you got into this particular venture, leaving from perhaps very comfortable jobs in the past, and just taking us from there, as it were. Perhaps Theresa?
Okay. So I co-founded Busbank in 2009, so I've been in the crowdfunding sector for a while now. And I used to be at Swiss Re, which is a large global reinsurance company. My motivations to change was I'd recently completed a London Business School Sloan Fellowship, and I was later in my career. I had 20 years of working experience, 10 years at Swiss Re. And I was very interested in the concept of social enterprise and social impact investment. So I come from a mission-led background. And I started looking at the sector in the UK, which had started to explore social enterprises and social investment. And I saw that although there were online sites to raise money for charities, donation-based, there was no way to raise money online for social enterprises. I met my co-founder, who had seen one of the very first early crowdfunding platforms, even before Kickstarter. I think Zopa was there at that point in time, so we had peer-to-peer lending as an example, but he'd also met a music site which was called Sell a Band. And one of the things they were doing is that not only was it your classic rewards-based crowdfunding, but they were also doing revenue sharing. And because a lot of social enterprises can't do equity, we thought revenue sharing would be a really great way for people to raise repayable finance. So that was the Kickstarter, so to speak. And we founded it. We raised money originally from charities and foundations. My background is technology, so basically I wrote and specified the tech. I mean, I don't program, but I wrote and specified the system. We got started. We launched in January of 2011. The crowdfunding market started to grow. I joined the UK Crowdfunding Association in 2013, was one of the founding directors. That was quite a movement for the sector. I met Julia Groves there, who's CEO of Trillion Fund, which was also coming from a mission-led background in the sense that they wanted to increase the number of people who were investing in renewable energy. And we thought, people, planet, we should get together, we should merge. We had the tech, she had the marketing, it was kind of a no-brainer. So we've been merged now for a year, and that's where I am today.
And John, what got you started on this as well?
I had previously I'd set up a business in executive search, which I sold in early 2007. And actually, it was around about that time. I think Zopa started in about 2005, 2006, and I was one of the first lenders on Zopa's platform. And so straight away, I was interested in the sector. For the first 4 or 5 years of Zopa's existence, they were very much the only ones that existed, certainly in the UK. And after selling my business, I actually then went and taught economics for 3 years. And I knew it was only going to be for 3 years. And I actually then went and did an MBA at Imperial College. And it was at that time I went there with almost the purpose of starting a business post-MBA. And it was one of the things that I looked at in detail, peer-to-peer. And actually, while I was doing my MBA, Funding Circle, obviously focused on SME, launched, and also RateSetter, which is a direct competitor to Zopa, launched at the same sort of time. So I started looking at sort of options within peer-to-peer, and I didn't come up with the idea for Landbay then. I then met my co-founder, who'd recently come to the UK from Australia, and he had come from a real estate background, and he was looking at doing something quite similar, and we ended up talking, and we started looking at options within peer-to-peer real estate finance. And at that time, a few had launched that were focused on sort of development finance within real estate and bridging finance and commercial finance. And we thought that they're sort of missing a trick, that the biggest market in the UK is residential mortgages. They're very, very low risk. They perform in the UK. It's recourse lending and there's no subprime. It's a very credit-worthy proposition. The British are obsessed with property, rightly or wrongly. So we thought people would get it in that sense. And so we ended up, although we set the business up in August 2013, we actually launched the site about a year ago, well, sort of May 2014, and have been lending since then.
Coming from the background of the UK and in proximity to that, Europe as well, why do you think this phenomena of social investing via crowdfunding platforms, as it were, has taken off so well vis-a-vis other countries that has been making an attempt of it, as it were?
One of the things, and again, I don't know why Zopa was the first, if that makes sense. And I think Lending Club in the US was similar, and obviously, but I think the main reason has been the regulation, I think. And again, I can't talk for every country, but certainly compared to other EU countries and the US, the regulation is simpler, it's more straightforward. The government and the authorities and Treasury are broadly speaking supportive. And I suppose also London is a financial centre, so there is that sort of expertise there, and it's also has got a tech centre as well, so it's the sort of merging of those two, I think. I don't know if...
I would completely, so it's a combination of, I think, obviously in the UK you have a high proportion of people who are e-commerce friendly, so they're comfortable with it. There's a high proportion of use, so they're comfortable to use e-commerce online, so it makes sense that the next transition would be to invest online.
Right.
The financial crisis, of course, destroyed a bit of trust in the traditional financial services, and so that allowed some of the new entrants to kind of enter on that basis. Now we look to collaborate with banks instead of banker bashing, and there's a lot of collaboration going on. Definitely the fact that London's kind of a fintech center, and there's other, so there's a small ecosystem there. There's accelerators. There's something in Canary Wharf called Level 39, and it's all about incubating and accelerating fintech, whether from blockchain to crowdfunding.
Yes.
The regulatory environment, I have to absolutely agree. The UK Crowdfunding Association, when we formed in 2013, the primary objective was to work constructively with government and with the FCA to build an environment that had investor protection at the forefront and enabled a level playing field for everybody, but also enabled innovation. So we obviously that's an ongoing balance and discussion. We have regular sessions with the FCA, for example. At the UK Crowdfunding Association, we'll invite somebody in from the financial promotions department to talk about social media. And we'll have a discussion about social media. When we tweet, what does this mean? When we Facebook, what are the kind of risk messages we have to put on? We have another session coming up about AML, which we're doing with the British Banking Association. So I think it also helps to work together. We compete, but we're also collaborating together to try to improve the sector.
Well, it seems very much to me that the ecosystem was just about right. And so from your own personal perspective, where you just highlighted to us as to how you started, do you think it was perfect timing for each of you, as it were? Was it perfect timing?
Way too early.
Way too early.
It was way too early. You can be too early. If you're early like Zopa, you have to have enough capital reserves to ride it out, right? I mean, we were trying to do too much at once. We were trying to do social investing, which is not social investing in terms of like from peer-to-peer lending, but social as in the social impact against solving poverty and issues and mental health issues. So we were trying to do too much. Our lesson from that was people hadn't heard of social enterprises, people hadn't heard of social investing, people hadn't heard of revenue participation, and people hadn't heard of crowdfunding. It was too much for them. It was too much change, too much challenge. Whereas Trillion Fund said, let's start with something really, let's just do wind turbines. Let's something people know, maybe not as well as property. So they had to do a bit of education around it, but it's there. And we only, with the wind turbines, we only refinance existing assets. So we either refinance existing wind turbines or existing solar panel farms, and that's a nice step for the investor to take. It's not such a big jump for them. So yeah, we were definitely way ahead of the curve, and so was Zopa. And there is a famous story of Zopa that they went bust, were bought by a pound, and grew again. So they did face financial difficulties by being so early, but bless them, they're now a major force in the market.
Yes, I totally agree, and I think the actual credit crisis was actually a big catalyst for the sector because on one side there were just the fact that interest rates were very low, so people weren't getting much return on their money, and banks obviously cut up various parts of their lending operations. They cut or drew back. So there was this opportunity there. And on top of that, the UK banks all sort of, their brands were heavily tarnished as well. So it wasn't just the fact that actually they weren't lending on interest, but all of a sudden, any halos that may have existed across UK banks, which I'm not saying they were there, were certainly removed. And there's a lot of scandals and fines, et cetera. So I think that sort of environment was definitely a positive for the sector in that sense, unfortunately. And one of the other things, and I think it's still an issue, and I think the difference between peer-to-peer lending and crowdfunding, I think crowdfunding is definitely an investment, and peer-to-peer lending is somewhere between saving and investment, depending on, and it's not a savings product, but it's an alternative to saving in some senses, and therefore you move toward investment. And so therefore, I think we are competing more directly with the banks, even though we're collaborating. And that actually presents a huge challenge, and that challenge still definitely exists. So in the UK, there are sort of 4 or 5 major banks that dominate the market, and people are more likely to die than move bank account. And I've banked with the same bank since I was 18, and that's a common story. And so what we're asking people to do is not just move from NatWest to Barclays, but move away from banks. And not away from banks, but to move some of their savings out of the bank and out of the safety of the financial services compensation scheme into something a little bit riskier and a little bit different. And I suppose actually crowdfunding has the same thing, probably, as opposed to investing in equities or investing in funds and et cetera. Listed equity. And so it is a different, on both sides, they're a different asset class. And so although the ingredients have been there's still a lot to do. That the number of people participating in the UK, it's still a tiny fraction of the population. So although I think over the last 3 years there's been huge growth on both sectors, and we're still pretty small.
Yeah, and you show we have a definition. So some people call peer-to-peer lending, that's not crowdfunding. The Peer-to-Peer Lending Association don't like to use the term loans-based crowdfunding or debt-based crowdfunding, whereas in the legislation it says operating a platform for the purpose of loan. So we have this definition debate, and it has to do with the fact that, of course, equity in early stage startups is risky, and it has a different level of financial promotion rules than lending. So they have to they do slightly different things in the user journey. The user has to, for example, categorize themselves and say, I'm a high net worth, I'm sophisticated, I'm advised, or if not, then they're what's called a restricted investor. And so we call them an everyday investor. And that means that but the rule is basically they can't put in more than 10% of their net assets, excluding their primary residence and a few other little things. So it's giving a signal that this is risky. So you've got 2 signals that it's risky. One, you've got a cap of 10%. The second signal is you're doing after that, you have to do an appropriateness test. So you basically get a little exam to see if you understand that this equity is not listed, that this equity is not transferable, or that if it's transferable, it's very unlikely you'll find a buyer, that you have to hold it for a very long time, you may probably never get back, et cetera. So we make them do a test. And this is different to the lending environment. So I totally agree with John's point that you've got savings, which is protected, very liquid, and then you've got equity over here, and peer-to-peer lending is in the middle, which is why the government is looking at introducing P2P lending as into the personal ISA, the individual savings plan, and so you would get a tax relief on the investments, the loans you make in P2P lending.
Now, I'd just like to touch on a bit that is least spoken for. I mean, coming from a regulatory background, everybody would be speaking for the investor. But nobody has been kind of doing some pickup on the businesses that has obtained the financing and capital. Just how has it been for them in terms of the impact, the kind of value add that it has supposed to bring? I mean, is there anyone tracking in terms of perhaps job creation? Have they grown in revenue and so on and so forth? Has anything been done, either from the association level or even from your respective platforms?
So we lend on mortgages, and so in that sense, to put it bluntly, we don't create jobs. These are mortgages on properties, and again, we are one of hundreds of mortgage lenders in the UK, maybe not hundreds, but a huge amount of mortgage lenders. I've seen something by Funding Circle, and I can't remember the exact number. Funding Circle obviously lends to SMEs. For every £10 million lent, X number of jobs. I think. So I've seen the headline. I haven't looked at the detail and how that's calculated. So, Funding Circle in terms of the SME side has since it launched about 4 or 5 years ago, has now lent about 800 million sterling in the UK. Again they do, and again obviously.
Nesta, Nesta does, together with the University of Cambridge, does an annual report on the alternative finance sector. Yeah. So if you've seen that report, the one from 2014, I mean, they are looking to try to understand the broader economic impacts of crowdfunding, whether it's equity, debt, rewards, social investment. I think the interesting thing is what they also did is they did do surveys of the borrowers, the SME borrowers, to understand why were they choosing peer-to-peer lending. And a lot of times, in the early days, it was they weren't getting some loans from the banks because they had tightened their criteria, or the transaction cost was too high for the level of the loan. Some of the early Funding Circle loans were £20,000, £50,000. So the transaction cost of a bank just couldn't cover it. Whereas the guys who founded Funding Circle and some of these other ones have, basically recreated their credit underwriting systems from the ground up, so they're better, they're faster, they're more efficient, and so they're applying their own underwriting criteria to those SME loans. What the SMEs are saying now, according to the Nesta report, is it's just faster. Price. It's a combination of price and speed.
That's about it.
And actually, one thing I should probably point out is, so we sort of started Lambay in August 2013. And we actually raised seed capital via a crowdfunding site called Seeders, which is for startups effectively in the UK. And so, about 20% of the equity in our business is owned by the crowd, about 300 individuals. And again, I know there are a lot of other businesses like ours, and we have 15 people working for us. And I'm not saying we wouldn't exist without Seeders, but it certainly made it a lot easier to raise that initial capital, and in total we raised about 300,000 over 2 separate rounds before we launched. So we've been through it on the other side, and we found it a great experience.
You walk the talk. We also raised money on Seeders.
I see.
Equity investment in us. It's important we walk the talk, that we do what we're saying.
Now I have a question specific to you, Theresa, is in that, how has the UK government helped to spur interest to invest in socially beneficial businesses via projects?
So one of the things, so talking specifically about social investment, in the sense of social enterprises whose purpose is to solve a social issue, whether it's poverty, mental health, through a commercially sustainable model. So that's the premise. And there's some protections around mission. The government has introduced something called the social investment tax relief. So basically, they're trying to encourage awareness and understanding of social enterprise. They're trying to encourage social investing and helping to offset some of the unknowns or risk around that, perceived or real or not. Real or not. But just because you haven't heard of it before, there's the perception that it could be riskier potentially, even though the life cycle of it, has 3-year trading history and so on, right? So if you compare apples to apples, so it's a 30% tax relief if you lend to a social enterprise, or if you some of them can do a kind of equity. Then you get a 30% tax relief immediately. Right. It's actually very similar. It's basically modeled. So if you lend £100 or invest £100, it's like you lent or invested £70. You get the 30% immediately, and it's based off the EIS model, which is the Enterprise Investment Scheme, which is there to encourage investment of equity into startups in the UK, and all both of us, I'm sure, benefited from the fact that EIS was available to our investors. To help offset that risk of an early stage equity. So it's quite interesting. We ourselves are quite risky because we're early stage tech, but the loans we're doing are materially lower risk. They're against existing assets, existing revenue streams.
which moves me to the question specifically for John. I mean, how did Landbase see the opportunity to focus particularly on your buy-to-let property market segment amidst the emergence of all the other crowdfunding or alternative investing online platforms that was coming to being in 2014?
Yeah, so we looked at, I said, peer-to-peer lending, and at that point there were two consumer lending platforms, Zopa, which was very established. At that point, RateSetter was relatively young, but it was doing well. Funding Circle existed, and there are a couple other business lending platforms, ThinCats certainly, and there may be some other ones. But they had existed, and again, my co-founder, is from a property background, and so the original idea actually was to do commercial real estate, actually not what we're doing right now, and that was the original plan. This is a riskier area of lending. It's a lot more complex. The loans are larger, and if you look at how it's performed, there's also structural issues around commercial real estate in the sense that people will always need somewhere to live, full stop, and that is not going to change. Yeah. Whereas the world is changing, and how people work and how people shop is changing. And so commercial real estate, you've got to almost try and guess where people shop and how they act. And so there's an embedded sort of extra risk to it, just purely from that point of view. And so we therefore looked at the mainstream mortgage market, the home loan market, so owner-occupied as it's called in the UK, is heavily regulated. It wouldn't be impossible for a peer-to-peer lender to do it. It would be complex, it would take time, we need to get extra permissions, and also there's other issues around it. The mortgage lengths are a lot longer, which would make it harder. Also, that area is very, very subsidised by the government. So those mortgages are very, very low. My mortgage is 1.1% in the UK. So offering that up on peer-to-peer lending, you're not going to get much take-up, however safe it is. And so that's not really viable. And the UK has this huge buy-to-let market. A lot of the housing stock that is rented out is owned by individuals who own 2, 3, 4 houses. Yes, whereas in a lot of countries, they're big corporates that own lots of houses and rent them out. So it's a bit of a unique market. And actually, the mortgages outperformed home loans for 9 years out of 10, pretty much. And it's backed by rent. So for us, it looked like an obvious sort of opportunity where the pricing was better than home loans, the risk was lower, and actually it just made more sense. The loan length is slightly shorter. They're still long compared to consumer loans. Our loans are 10 years. And again, the regulatory environment was right. So it was sort of, and again, it was a big market. And I think peer-to-peer and crowdfunding, generally speaking, they work on scale. I think all businessmen, they need to, if you go into too niche area, it's very, very hard to have a sustainable business. I think you need to go into an area that gives you the potential to become a sizable business.
Yeah, okay, thank you for that. I'm going to come back to Theresa again, where I would like to just pick up on Trillion Fund. As I understand it, you recently started white labeling the peer-to-peer lending technology platform. And can you tell us a bit about your clients who have utilized these white label solutions, and how does it help their businesses?
Okay, so kind of from day one, just because I think because of my technology background and then some of the discussions we had on the board, we thought it would be very good to architect the technology to be able to white label in the future. So that I built in quite early, although of course we were focusing very heavily on the actual channel of BuzzBank. But it was because I had white labeled that we could do a deal with Trillion Fund. So Trillion Fund was my second white label client.
I see.
My first one was in South Africa. So that was my very lovely partner to really prove the concept. So he was willing to take a lot of risk and help prove the concept, and he worked really as a partnership with us more than as a client. And so together we kind of took the base, proved the concept in South Africa. It's a rewards-based crowdfunding in South Africa because the regulatory environment there, he felt was not ready yet for equity or debt. It's not supportive enough, so he started with rewards. But Trillion Fund came along, so they needed a technology solution. They decided by the time they got there that they were going to buy instead of build. They'd given up on the build. So that was actually the first conversation, was white labeling for Trillion Fund. So Trillion Fund was technically my third client, because I consider BuzzBank as kind of the first client. But yeah, that's the third instance I'm managing. In the meantime, we have almost launched a fourth one with a small bank, but but because they have internal structures and they were anyway focusing on a lending platform that was going to be of a philanthropic nature, a bit like Kiva. The marketing priorities of the company changed.
Okay.
So it was, so the technology is there, and what we're looking at now, what we think is interesting is when you white label, that's somebody's core business. I don't know, it was interesting, the exchange fellow who was talking on the first day, and he said, when you sell somebody a piece of technology that is their core business, it's a really, really heavy commitment that you're making. You need to make sure on both sides of your counterparty risk that they're going to be able to provide you with that solution. So what we're looking at now is, because of the way the technology is built, is doing branded gateways. Branded gateways is for organizations not who are going to live and breed crowdfunding every day necessarily, right? But organizations who want to keep their brand and raise a particular issue, whether equity or debt, and do it under their own brand. So it's kind of a one-off exercise for them, maybe. So we give them a branded gateway. It's their logo, it's their client base. We just provide the permissions, the tax, the administration, the support, the advice, the consulting.
Right.
And so we think that could be interesting. And we have been talking to a large energy utility company in the UK who would like to do an issue, but they want to do it under their own brand, and they want to they want to use that process of raising the money as much as a customer connecting exercise, a brand exercise, as raising the money. So they see two values in raising the money.
Coming back to John now, some home buyers are actually concerned that real estate crowdfunding is akin to group property buying through syndication. Allowing various platforms to take on this particular role will result in excessive speculation in the local property market, thereby driving house prices up even more and actually pricing actual homeowners out. What are your thoughts around this? And this is something I think that will be quite peculiar in as far as the debate is concerned in the Asian environment.
Yeah, I mean, there are, just to be clear, we're a lender as opposed to, but there are, as you say, in the UK. I know of 3 crowdfunding property websites that then rent the property out. There are probably more, but there are 3 that I know of. They're relatively small. Most of them have launched in the last 18 months or so. My guess is between them they've probably done 30 properties, 40 properties. So whether that's having an effect on house prices yet, I'd be very surprised. It's a common thing that actually, buy-to-let pushes up, whether it be mortgages or whether it be crowdfunding or investors or pensioners who are buying with the pension forms, all these things are pushing up house prices. The fact of the matter is that in the UK, 100,000 houses are built every year. Net migration in the UK last year was 330,000. On top of that, people are living longer, people are divorcing earlier, marrying later, and so the population is growing hugely, and we're not building houses. That is the reason. It's a basic supply and demand, and there is a huge demand for people to rent houses, and whether that be people who are young, and increasingly nature of people's jobs, they're moving around, so they don't necessarily want to buy a house and live there all their life because people's work patterns have changed. UK and particularly London is a very global city. People come and work here for 2 years, 3 years, and again, net migration, those 330,000, I bet very few of them are thinking about buying a house. They'll rent. And so there's this demand for rental that exists. And so it's important that there is a market for rental housing. It's not healthy for everyone to own houses in terms of having a liquid jobs market. That's the point on house pricing, I'd say. In terms of is it good that people are investing speculatively in property through crowdfunding? To be honest, I don't think it's any worse than speculative investing on any asset class, whether it be crowdfunding into startup equity. I think if the platforms are managing it well and people understand the risks, people gamble online hugely, so is it better that they buy a share in a house than gamble? So my view on it, actually, as long as they're well managed properties, and people are aware of the risk. And also, the other thing is the fact it's not liquid. And I think that applies to both peer-to-peer lending and crowdfunding, that if people are investing, because they have a fractional ownership of either a loan or a property, there might be a secondary market, but you can't ever guarantee it. So that's what I'd say. I think the other thing that's very important, and I've seen some instances where people invest in property for one of two reasons, pretty much. One is they expect house prices to go up, provide some income, as in rent. And what you find in the UK is in the south of the country, and particularly the southeast, you don't get much in the way of yield. Rents are, because the properties are expensive and the rents are relatively low compared to the house price. They're not low, but they're relatively low. And therefore, the main driver is you expect the property of the house to go up, the value of the house to go up. In other parts of the country, and particularly sort of north, the exact opposite is true. The yields are double digit, but you buy a house today and it's probably worth exactly the same in 10 years' time. So and again, economics suggests you can't get both, or unlikely to get both. I've seen some instances of sites advertising expected growth of property value and a yield, where I think there's an element of taking the best of both, if that makes sense. So promising sort of London growth and northeast yields, which it's technically possible it could happen, but I don't think so. So I think any form of investment, I think as long as people and platforms are very open about the risk, and it's not just they might lose money, it is also they might not be able to get the money when they want it. And also if the business, the platform itself goes under, there's some way of managing that property in existence. So I think as long as it's structured, I don't have a problem with it really, personally.
Okay, yeah. So picking up on the point about some of these facts and figures that are going onto the investments through your respective platforms, how does both Trillion Fund and Landbay guard against possible fraud and for businesses that actually misrepresent facts and figures when seeking investments through your respective platforms? How have you kind of guarded against that? I'm sure that's a development that you have to take on as and when it arises.
Yeah, and I think it's probably easier on a credit platform than as in debt than equity or crowdfunding. When we make underwriting decisions, we see bank statements, we verify AML, and also particularly as we're secured lending, worst case scenario, we have a first charge on that house. And where you've had instances of fraud in the past, in the UK, is actually around the valuation of that property. And so the property is worth 120,000, but someone gets a valuation done by someone who's friendly with them, and they get something for 150,000, and people therefore get a bigger loan. And again, you can guard against that. You only use your own valuers, and again, you can now do online valuation. We still have someone visit the house, but you back it up with online valuations that just verify they're not as accurate, but if they should be within 5% of each other. If they're not, then you ask questions, and then there's a sort of legal process to go through. So personally, I don't think you can ever say fraud is impossible. It's not. There's always a chance that someone finds a way around the system or gets money out of it, and we feel we do as much as we can. But as I say, you can never. Anyone that says fraud is impossible, then I think you're setting yourselves up for a fall.
You're just really trying hard to manage and reduce the risk.
Yeah.
And I think so. Trillion Fund does debt just against renewable energy. So the kind of loans we do are like 1.25 million, 1.75 million. Okay. And so because of the large ticket item, we do an extensive 6-week due diligence on the wind turbine or on the solar system, so it's a solar panel. So there is a due diligence around, what's, and this is by people who are experienced in renewable energy technology. So they're going in and they're looking at the wind data, or they're looking at the solar data, or they're seeing, we're refinancing existing assets. So we've got the data. We know they know all the developers. They know all the manufacturers. They know who's manufactured that wind turbine, where that panel has come from. So they understand the industry inside and out. And then they're able to they look to make sure there's not any other charge against the asset. They look to make sure what if there's parent company ownership, how is it structured? Is it an SPV? Do we have 100% control of the SPV for that particular asset? So they look at all that, and then we, because the loans are so large, we produce an offer document. It's not a prospectus, but it's an offer document, and it's part of the financial promotions process. So every word in that offer document has evidence or has a material risk statement proportionate to the process of so for that we're staying. So we follow the financial promotion rules around prospectus in the way that we build the offer document, but we try to do the offer document in as plain English as possible. So whereas Funding Circle on the SME side is doing an extent, they've developed their own in-house credit and underwriting systems to assess that SME. Whereas we see, it's quite easy in renewable energy. There's the agreement that they've got for how much pence they're going to earn per kilowatt, and that's been secured. There's the feed-in tariff, and where's the insurance contract for the wind turbine if it breaks down? There's the insurance contract. So it's that's why we started with renewable energy or Trillion did, because they felt that was a great way to offer an asset-backed loan as a good stepping stone for people. And like John, people like to, it's good, they can physically see the wind turbine.
Certainty.
We show them photos of the wind turbine. We show them videos of the wind turbine turning, I mean, we have also a bit of a campaigning aspect, I might say. So we want them, but it's the same as property. You can touch it, you can feel it, it's something real. So it's a good way for people to get started on investments and lending if they've never done it before.
Now I would just like to step a bit into the future. I mean, where do you foresee in the years to come, especially for your respective businesses and crowdfunding in general, will take place? And are there certain segments that you think will gain traction into the future, although we are still very much into early days? What would be the possible mega trends, as it were?
Yeah, I mean, for us, we're our short term, next 2 years, and it's hard to think beyond that, is to stay in our, focused very much on buy-to-let and residential property. There may be small niches that we can move into within that we don't operate in at the moment. In terms of the industry, I think, to be honest, there's probably not much that's not crowdfunded or in the UK or peer-to-peer. I mean, I can't think of many lending markets now. I mean, there is one in the UK that I think you can lend against planes and yachts. I mean, so
there's some specialised lending going on.
So it's quite hard to think of where else it could maybe crowdfund. Government debt maybe could be.
Actually, somebody proposed that.
Yeah, someone's proposed it. So I think, I think, again, I think and you're starting to see it already in the UK, on both sides of the fence. I mean, Cedars have started operating in the US and various European countries. I think as a Crowdcube in European countries. Within peer-to-peer, Funding Circle has an operation in the US. Rate Setter has opened in Australia. So I think you'll start to see over time some globalization and move across it, and then with that probably some consolidation. I think if all the UK platforms are moving into the US, then there'll be a combination of actually let's merge and tie up, and that. I mean, that hasn't really happened to date in any serious scale, but it's happened.
We were a small merger.
Yeah. Oh yeah, sorry. Yeah.
No, but it is little. Yeah. The mergers to date have been little.
And as long as Funding Circle's move into the US actually was an acquisition.
Yeah.
So I think you'll see more. I mean, the rest of Europe outside of UK is still a relatively immature market in that sense. So I think that's probably an obvious point for people to go into in different segments. It's probably harder in ours actually because of the regulation around mortgages and that particular around buy-to-let. And again, I think as I mentioned yesterday, I think Asia is, I mean, there's a lot of talk about the Chinese peer-to-peer platforms and crowdfunding and how big they are, and they are huge, but people are forgetting a lot of the other Asian markets which are still significant, and the opportunities potentially exist there.
So I think every kind of finance you can think of, somebody is going to try to crowdfund it. So I'm going to put my money on insurance next.
Insurance?
But I think, I think you've got geographical expansion, whether it's lending or equity. In the UK, we've got invoice financing. That at the moment is still really focused to, I think that's an opportunity to open up. So I think, or specialization where there's a specific risk profile that you need to understand it in a certain way, so you become an expert in underwriting that. But I'm going to bet on insurance.
Yeah. So you don't see yourself moving out to the new nascent markets, as it were, just as much as you said that it's getting pretty crowded out in the UK. No courage or stomach for that?
We do. I mean, we're still quite a young business, and I think we've been lending just over a year. We have, obviously, mortgages have this extra complexity around regulation on that side. So we wouldn't want to move into any market that we weren't 100% certain about the regulation on both sides, both the lending and the taking money coming in and money going out. And also, I think it's very important culturally. There's a huge to move into a country and offer a financial service product without understanding the culture and how people bank and save and invest would be a huge error, I think. And so, I think if we were to move to any market, we'd want to do it with someone who was local in some way. I think to go out and step into a market, the cultural stuff in some ways is probably more important than the regulatory stuff. Because I think peer-to-peer, if you look at how, and crowdfunding, how it's structured in different countries, there's subtle differences between how it's done in the US and the UK and the Germany. From the outside, it all looks the same, but actually the legal structure is very different. So you can probably always structure something to makes it look right. But the cultural thing, I think, is much harder.
Yeah, I would totally agree with John. I mean, but it's something we are looking at because of the way that we've enabled the white labeling and branded gateway technology. So, and technically I am international in the sense that, we have a service in South Africa, but importantly, that was with a partner in South Africa. So, yes, I think, in fact, the fact that we offer white label, I have been contacted to discuss, looking at a white label project here in Malaysia. So let's see.
This is great.
Yeah.
So I'm sure we'll see you coming back this way again. Which leads me to my last question in that the larger financial institutions and especially out in Asia, the cooperatives has been playing a bit of a role in terms of what has been happening on this space. Do you see with what is happening now, whether these large financial institutions and cooperatives, as it were, will be fighting back? Do you think platforms like yourselves will be taking over? Or will there be something kind of settling in between?
I think it sounds a bit boring, but probably in between. And in terms of fighting back, we're tiny, and I mean that as a sector, we're very tiny. And so I think banks are interested in the sector. They can see the growth, particularly of the larger businesses like sort of Funding Circle and Zopa. And we've seen tie-ups in the UK, and so far the tie-ups have been with generally what's known as the challenger banks, smaller banks, as opposed to the large, well-known high street banks in the UK. We work with them, and we've spoken to a number, and I think actually, it will become more collaborative as opposed to out-and-out competition. There are probably 70 or so mortgage lenders in the UK, and so an extra one or two doesn't make a huge difference, if that makes sense.
I mean, I think banks have always been looking at us and exploring and talking to us. I remember being called into a bank for discussion already in 2011. It's not a monetary risk for them. They could put 3 million into a crowdfunding platform to seed it, see how it goes, test it out. But they're so worried about the reputational risk that they don't want to make that small step, just play the field, see how it's going. So I've had constant conversations because of the white label, constant conversations over the last 3 to 4 years. But it's always been, not yet. Oh, we're not sure yet. No. Have to think of the brand, have to think of the reputational risk. Where is it going? Is these that, So they're still quite hesitant. But I think, in terms of actually running or building or investing in their own platform, as opposed to, I think, the way they are putting their toe in now is the way Santander does. Unless you know of a deal I haven't heard of lately.
I think there'll be some. I mean, ironically, there's a number of banks, their reputation is so low, you're thinking actually the reputation...
What would it matter?
What does it matter?
I forgot to use that argument when I was selling. Okay, so I'll use that one next time. But interestingly, we've seen the big accountancy firms start talking to us. So there's the big six in the UK and the accountancy and advisory firms who think, this could be something. So, there's one large accountancy firm who does a lot of SME, very small SME accounting. And so they're kind of like, we know them well. We could maybe develop something here. So, I think it's going to be interesting where investment players come, where we exit. Who do we exit to? So it's going to be interesting.
Yeah, and I think Lending Club has got so large in the and obviously the IPO was so high profile. I think it was a bit of a wake up moment, and I think obviously the stock price hasn't performed that well since the first day, which is disappointing. But even so, I think that. It was a bit of a wake-up call to some of the. I mean, we got, and I know some of our competitors did, that around that time is when they banks sort of started reaching out and said, "Oh, can we come and have a chat?" And we weren't the only ones. I know there's quite a few that just so they're sort of trying to think 2 or 3 years ahead. Which of these might end up being something like that? So I think their fight back will probably be to try and do something with platforms, and whether it be collaboration, whether they actually go out and buy one, who knows?
Okay. Well, I think on that note, we can round off our discussions, and certainly we can wait for the outcome as to where this will take us, whether there will be a fight back somewhere in between, or perhaps you may just succeed. Right? And on the note, may I just thank you for coming by and joining me on a conversation at SC that is occurring on the sidelines of the World Capital Market Symposium 2015. Thank you.
Thank you for having us.